Hey everyone, in this video, I'm going to compare two dividend stocks that are yielding 5.5% and 6.7% and answer which one I think is the better dividend stock to buy for passive income investors in 2024 and beyond. But I'm going to look at more than just their dividend payout. I'm going to look at other factors that could make this a good or bad investment for passive income investors. So without further ado, let's get into this. Let's see what these two stocks are and which one I think is the better dividend stock to buy.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so the two stocks I'm comparing here are 3M and AT&T. 3M offers passive income investors a 5.55% dividend yield, while AT&T offers passive income investors a 6.74% dividend yield. Both of them are on the higher end of the dividend yield in terms of dividend stocks, but there's more to consider, so let's go further. The dividend payout ratio. The dividend payout ratio measures the percentage of earnings per share that's paid out in dividends. It's a measure of how sustainable dividends are. For instance, in this first example here, you have a dividend per share of $1.75 and earnings per share of $2. That means that's a dividend payout ratio of 88%. That's relatively high. That means if earnings per share were to decline below $1.75, that company would be paying more in dividends than it's bringing in earnings. And just like a household that cannot spend more than it brings in earnings for the long term, in the same way, a business cannot pay dividends more than it brings in earnings per share for the long term. Sure, in the short term, it can borrow money to pay the dividend, but eventually it will exhaust its borrowing capacity. Additionally, it can pay dividends out of its savings, but eventually it will run out of savings. That's why in the long term, if you want sustainable dividends, you want a dividend per share that's below earnings per share at a comfortable level, like the second example here, where you had a dividend per share of $2.75 and earnings per share of $10. That's a dividend payout ratio of 27.5%. For passive income investors, what this means is that the dividend is not only sustainable because even a drop in earnings per share of 50% would still mean that the dividend per share is below the earnings per share. But it also suggests that there is room for this company to increase the dividend payment. So investing in this company brings with it the probability that the dividend per share will rise over the next several years. And finally, the last example where we have dividend per share of $3.50 and earnings per share of $1.45, that's a dividend payout ratio of 241%. The dividend payout is more than 2 times the earnings per share. When you see a situation like this, it's likely that this company is going to pause or reduce its dividend payment. That's very likely to happen in the near term unless the company can expand its earnings per share in a relatively short amount of time. So now that we know a little bit more about the dividend payout ratio, let's look at 3M and AT&T, their dividend per share and their earnings per share over the last decade. And you can see two interesting trends here. Starting with 3M, you can see its dividend per share has consistently been below its earnings per share for the last decade, except for this recent year. What happened here? Well, you may have been aware of the legal lawsuits, the disputes that 3M is facing. It could cost the company of billions of dollars. It's already cost the company a significant amount of money, and that led to a decrease in its earnings per share in the trailing 12-month period. Although I will highlight that this is not alarming for 3M stock investors because the company first takes the loss in terms of income statement. However, it does not pay all the cash payment for these disputes, these settlements. It pays those over time. So it spreads that out over several years, and so it can sustain those payouts while keeping this dividend per share. Next, AT&T, a little bit different in that it's been choppy up and down over the last decade. Overall, the dividend per share has been above its earnings per share, although there have been moments where it's been below, like the most recent period where it was negative $1.54 earnings per share. AT&T has been divesting out of some of its business, taking write-offs, taking downgrades, and that's why its earnings per share is falling or has fallen. Longer term, AT&T has excellent profitability, as I will highlight. In shorter term, it faces choppiness in terms of the reported earnings per share. So the next thing I wanted to look at is revenue. Now, interestingly, 3M has experienced overall revenue growth over the last decade, $32.75 billion in the most recent period, compared to about $31 billion about 10 years ago. The difference between 3M's short-term decline and AT&T's short-term decline. 3M, for the most part, experienced revenue decreases coming out of the economic reopening because people are spending more money on services and less money on goods. 3M is an industrial giant, has its products in several products you may be surprised to hear about, while AT&T divested away from a business, namely it sold DirecTV, and that caused its revenue to decrease because now that's no longer included in AT&T's performance. Going forward, you can expect better revenue growth from 3M because the markets that it operates in are growing more than AT&T. The wireless phone industry is pretty much saturated with very few new customers coming in, and therefore AT&T's revenue growth is going to be very, very small, relatively speaking, compared to most businesses. 3M is not, it's not like 3M is going to be growing revenue double digits or anything like that, but it should be growing revenue faster than AT&T. I mentioned that AT&T is nicely profitable, 20% operating profit margin in the most recent trailing 12 months. You can see 3M has been more profitable than AT&T for the most part, save for these last year and a half. And that's because of those lawsuits that have cost the company billions on the bottom line. And so its profitability, those numbers are going to be less meaningful for 3M because of these write-downs and write-offs and the mismatch in timing between when they take the loss on the income statement and when they actually pay out those benefits in terms of the cash outflow. So for that reason, there's a little bit of a mismatch for 3M here. That's why I gave you that 10-year perspective, because that's a better information, that's a better insight into the company's profitability prospects than what it's been doing in the last year and a half. I also wanted to look at long-term debt, and in this metric, I wanted to show you how massive AT&T's long-term debt balance is, $138 billion. It's been working to bring this down from over $180 billion. However, it's still elevated compared to 3M with $16 billion in long-term debt. Although remember, they're at different scale in terms of revenue and compared to revenue and long-term debt. 3M at $32 billion in revenue. AT&T has nearly 4 times the revenue of 3M. Still, when you compare debt to revenue, 3M has about 50% debt to revenue, where AT&T has over 100% of debt to revenue. So proportionally speaking, AT&T's long-term debt is more of a concern than 3M. And finally, I wanted to compare these two on valuation. 3M is trading at a forward price to earnings of 10, while AT&T is trading at a forward price to earnings of 6.6. So all of these things being considered and everything else I know about AT&T and 3M stock after following these two for 5 or more years now, I would pick 3M as the better dividend stock to buy today. If you liked the video you just saw and you want to see more just like it, please subscribe to the channel. I can't keep this channel free without the support of viewers like you. And if you're already subscribed, thank you, and I appreciate your support.